Hello YouTube, welcome back to my channel. My name is Patrick Boyle and this is Patrick Boyle on Finance. And today's video is a little bit different to my usual videos in that I've just really received a lot of questions about what's going on in the futures market today. And I put up all these videos explaining financial derivatives to people. And so I thought I'd give a quick update on what's going on. So it's April 20th today, 2020. April 20th, of course, being Elon Musk's favorite date. But what's happened today is that oil futures, the May oil futures contract has fallen into negative territory. So let me explain what that means. Okay, so this is the first time in history that the oil futures have traded in negative territory, and this is also the largest fall in price in record going back to 1983. And so what's happening exactly? A lot of people have been joking that they should run out to the petrol station and fill up their car for free or be paid to fill up their car. Well, that's not actually what's happening, but it's fairly close to that, at least in idea. So today the June contract, the one that's expiring next month, is at $20.03 a barrel, at least as of the time of recording this video. But the May oil contract fell into a negative price. So the May oil contract, it's worth noting, expires tomorrow at the close of futures trading. We need to just better understand futures financial derivatives and how they work. So we'll start out firstly with the simple idea that we can all imagine is that there's lots of people out there who want to invest in oil. They want to invest in oil because they might feel that the price is likely to go up. Now you can equally bet on the price going down, but let's work from the idea of someone who thinks that the price is likely to go up. They want to invest in oil and they basically might want to buy oil today at whatever price it's trading at and hold on to it until the price has gone up to a level at which they've made a reasonable profit, right? But that's not actually how investing in oil works. And the reason for that is that oil is messy, it's poisonous, it's flammable, and it's smelly, right? So you can't buy a load of oil and keep barrels of it in your back garden. You can't fill up the swimming pool with it because your neighbors just are going to complain. So that's not how it works. You have to then buy some sort of financial product that's based upon the price of oil. And so the financial instrument you buy will be a bet on oil prices without the mess, right? That's kind of what you're looking for. And you might want one that you can buy it now, as I said, and hold on forever until the price moves to a level that you think is a good level. But that's not actually how these things work. And if you want to learn more about this, I have other videos on futures, and I also have a video on contango and backwardation, which is kind of what this video is all about. But all of these products, all of these investment products that relate to the price of oil expire, because when you're investing in oil, unless you actually buy oil and store it in a shed somewhere, you are buying a financial instrument that is an agreement where you're going to buy oil, physical oil, from someone for delivery at some point in the future, at which point you'll pay them, and you're fixing the price right now. That's what a futures contract is. It's an agreement to buy something at some point in the future where you're agreeing on the price today. And so, of course, that date eventually comes about, right? So that's what's happening in oil right now, where people bought these futures contracts that expire tomorrow, and they will have to take delivery of oil if they still own those contracts. Now, what people often do in investing in oil or investing in commodities futures is they buy what we call the front month contract, and that's the contract that's the next one to expire, and that is usually the most liquid contract, and by liquid I mean the easiest to buy and sell, right? And so what you would do if you wanted to own oil for the very long run, you might have bought the May contract, and then as time is going by and it's getting close to expiration, like tomorrow, you would then sell that May contract and buy the next contract out, which is the June contract, and we call that rolling the futures. And so you're constantly buying, we'll say, the front month or a near month futures contract, and then you hold on to that up until close to the expiration date, at which point you either, maybe if you're done with your trade, you exit for good, or if you want to keep it going, you then sell that contract and buy the one that's expiring next. So you might be selling the May contract, buying the June contract, and then in a month's time you'll be selling the June contract and buying the July contract. Now, a few of you are possibly thinking, but Patrick, don't you know about ETFs? Well, I do know about ETFs, but an ETF doesn't, if you're an ETF fund manager, you don't have a huge storage area filled with oil, a big lake of oil that you store it in. You're still trading these futures, right? So if you put your money in an ETF, the ETF manager takes that money and uses it to invest in oil futures. So you're kind of still, even with ETFs, even though that looks like something that never expires, it's still tied to this idea of expiration. And so once again, an oil ETF, an ETF stands for electronically traded fund, for those of you who haven't heard that term before, gives its investors an exposure, once again, to a financialized version of oil. So it's not actual oil, which you have to store somewhere. It's a financial version of oil. But of course, the financial version of oil is then backed by this other financial version of oil, which is futures contracts, which is backed by actual oil. And so that's kind of how that market works. Now, someone thus still has to store the actual oil, right? Because we're doing all of this financial stuff, trading in futures or ETFs, but there is someone in the background actually dealing with the oil and either storing the oil or selling the oil to someone who needs it to consume. And so that oil that you own in sort of an abstract way through a financial contract is actually physically out there in the world somewhere. And so when you're rolling the future, selling, we'll say, the cheap May one right now, a very cheap May one because it's got a negative price, and buying the more expensive June one, what you're actually doing in a way is paying someone to store that oil for a month for you, right? And let's think, the term that we use in finance for the difference in the prices is contango. And as I mentioned, I have another video that I'll link to in the description that explains contango in greater detail if you're interested. But essentially rolling the futures the way they are right now, where you're selling cheap May oil and buying more expensive June oil, the difference in the price is kind of what you're paying someone to store that oil for you. Now, of course, someone can do the opposite of that, right? They could easily buy the cheap May oil contract, sell the more expensive June one, and then receive the oil when the contract expires, store it for a month, and then redeliver it to whoever needs it. And that would make a profit for them, assuming that they had the ability to store oil somehow. Now, another way things can work, because the prices aren't always, it's not always lower for the near delivery than the longer delivery futures. Another way it can work is what we call backwardation. And as I mentioned, there's a video on that, and that would be where the price of June oil is above the price of May oil. And what that would then mean is that the markets are essentially saying that they will pay you to take oil out of storage because people really need it right now. And so usually in the oil market, in a lot of energy derivatives, you see what they call normal backwardation, but that's not always the case. So right now, what is happening in the oil market? Well, people do think that oil is valuable because, as I mentioned, the June contract is trading at around $20. And people do want to bet on its future price, but no one wants it right now. In particular, no one wants to own the contract expiring tomorrow, basically because in this environment with the whole COVID-19 lockdown, no one's really using as much oil as they normally do, and they don't really have anywhere to store it. So thus, the May futures contract has gone negative. Now, what does is this just a financial thing, or does it tell us something about the real world? Well, financial things always tell us something about the real world. And so what we can see about the real world in these prices, they're kind of highlighting a fast-growing glut of oil in the world that relates to a number of things, such as the price of oil being reduced by Russia and Saudi Arabia, but also just the fact that there's really much lower demand right now for oil than you typically expect, simply because of the COVID-19 lockdown and people aren't driving, factories are not all open, airplanes aren't in the air, and so on, and so less energy is being used. And in addition, it also highlights growing stockpiles. So in the United States, a lot of the oil is stored in Oklahoma, and those storages are pretty much full at this point. So what are they calling this? Well, they're calling this super contango, which is of course like contango, but it's super. And the June contract is way above the May contract in terms of price. So it's much more contango than you would normally see. And this of course relates to all sorts of signs of economic weakness and just weirdness in the markets that we're seeing during this COVID-19 lockdown. In Texas, buyers are offering producers as little as $2 a barrel for certain streams of oil. It's worth noting that very little oil actually trades at the price that you see in the futures market, because of course different oil comes out of different wells, there's different delivery, there's different qualities of oil, and so on. So the price that you see in the newspaper of oil is kind of more of a benchmark price, but then the actual oil trades at different prices based on different deals that have been struck, and so on. And there is actually the possibility that producers might soon have to pay someone to take crude oil off of their hands. Now, what does that mean? Because that's kind of weird as well. In normal economics, you would think there would be no negative price. We couldn't have a negative price, simply because if someone is offering it, if you have oil and someone is saying you have to pay me to take it from you, you might say, well, actually, I'll just keep it in the ground. I'll just hold on to this oil. But the oil market is a little bit different and a little bit more complicated than that. And part of it is just tied to this idea that oil is hard to shut into the ground. Like once you've got these wells flowing, you can't just sort of turn a tap and stop them. It's more difficult from an engineering perspective than turning off your kitchen sink, for example. And if you do shut it down, it's difficult to restart an oil well. So all of this stuff is kind of playing into what's going on in the oil market. In general, a global pandemic like what we're in right now is just weird for all commodity prices. If you have a thing that lots of people want, but nobody wants it right now, like oil, it's very difficult to put a normal price on it. And that's what we're seeing in a lot of the world of commodities, and even just in a lot of the world when we look at stock prices or, business investments. It's very difficult to put a price on things right now, simply because it's very difficult for people to know what's going to happen going forward. So anyhow, hopefully you found this video a little bit interesting. As I mentioned, I have other videos that I'll link to. Please like and subscribe if you found this useful, because this is the kind of content I make. And do let me know in the comment section if you'd like more kind of market update type stuff like this. Normally I don't really comment on today's market, but basically I got a lot of questions and I thought this would be the easiest way to answer them. So anyhow, have a great day, guys, and talk to you later. Bye.